Welcome to vTalkInsight, Market Drivers Daily for May 18th, 2026. Oil above $100, long-dated U.S. yields above 5%, and AI megacaps still anchoring equity indices are pulling markets in different directions. Today we connect the Gulf energy shock, the AI trade, and shifting rate expectations to see what is really driving cross-asset pricing. Energy has moved from a background risk premium to the central macro driver again. Persistent tensions around the Strait of Hormuz, stalled U.S. Iran talks, and drone attacks on Gulf infrastructure are keeping Brent crude around $110 to $111, while physical cargo prices trade even richer. Equity markets are now in a broad risk-off phase, with a significant dip expected to run for several weeks as investors absorb the implications of a more durable energy shock. Under the surface, the supply backdrop has deteriorated meaningfully. A tanker bottleneck off Iran's Karg Island, de facto tolls on Persian Gulf shipments, and the ongoing closure risk in Hormuz sit on top of an estimated 14 to 15 million barrel per day global shortfall and near-depleted inventory cushions. That combination raises the odds of a sharp move higher in benchmark prices, with some scenarios flagging $150 oil and a second major inflation shock before growth visibly rolls over. The immediate impact is a classic stagflation pattern across assets. Energy stocks, including European majors like BP and Equinor, are outperforming as oil grinds higher, while travel and leisure names are under sustained pressure as fuel costs spike. Jet fuel prices are rising faster than crude. Inventories in Europe could drop to critically low levels later in the summer, and airlines may need to cut capacity by mid-teens percentages if Hormuz remains constrained, with a highly import-dependent UK aviation sector particularly exposed. Macro spillovers are building. Higher pump prices are already squeezing consumers, with U.S. gasoline at multi-year highs and Asian importers such as India and Japan wrestling with acute inventory and funding challenges. Scenarios where oil holds near $120 into the second half see global growth forecasts marked down from around 2.6% to near 1.5%. While persistent triple-digit crude could threaten recessions in both the U.S. and Europe and weigh on S&P earnings, especially given large overseas revenue exposure. Policy and geopolitics add another layer of volatility. Washington is pushing G7 partners toward tougher sanctions on Iran, even as reports circulate about potential temporary waivers on Iranian crude that have already triggered sharp swings in Brent and Treasury yields. China's continued purchases of Iranian oil, limited diplomatic leverage over Tehran, and signs of disaster fatigue in markets mean both upside and downside tails remain in play, from a de-escalation path that eventually normalizes Brent toward the mid-70s to a hot conflict that drives a violent spike. The key watch points now are physical stock draws, any divergence between paper and physical prices, concrete news on Hormuz flows, and how severely European airlines and Asian importers curtail demand. Against that backdrop, the one consistent growth engine supporting risk assets has been the AI complex. Despite higher energy costs and rising yields, AI continues to anchor the equity story. The capex wave behind data centers, chips, and cloud infrastructure remains intact, with AI-related spending estimated to account for a very large share of recent GDP growth and corporate investment. Current weakness in broader equities is still framed as a pause within an AI-driven rally that many expect to carry indices back to record highs later in the year, provided earnings momentum persists. Market attention is concentrated on a handful of bellwethers. Upcoming NVIDIA results are seen as pivotal for index direction, with options markets pricing a 7 to 8% move around the print and investors focused on progress toward an ambitious data center revenue target. Analysts still see scope for over 70% year-on-year revenue growth and argue that, despite a forward valuation in the 20s, strong earnings justify ongoing appetite, while Korean memory producers and Samsung benefit from multi-year supply agreements with hyperscalers. At the same time, signs of froth around the theme are hard to ignore. Options activity in AI leaders is at extreme levels, with call skews near historical peaks, and some of the enthusiasm appears driven more by fear of missing out and price momentum than by clear evidence of broad-based productivity gains. There are concerns that demand for high-end chips may have pulled forward future orders. Smaller industrial names tied to AI capex look stretched relative to fundamentals, and rising costs for AI services could eventually slow adoption and revenue growth. Structural constraints and policy risk round out the picture. AI demand is creating a pronounced energy footprint, with access to power now a binding constraint for data centers and driving record-scale utility consolidation, as seen in the proposed $67 billion tie-up between NextEra and Dominion. AI-related spending is also contributing to near-term inflation, which could make central banks wary of easing too quickly for fear of inflating an asset bubble, even as debates grow about future regulation, taxation, and labor market impacts. Key watch points from here are NVIDIA's guidance, the pipeline of AI and space-related IPOs, evidence that earnings strength is broadening beyond a narrow group of hardware names, and any signs that power or funding constraints start to slow the build-out. All of this is colliding with a bond market that is rapidly repricing the cost of money higher. Rates markets have shifted decisively back toward a higher-for-longer narrative. Global bond yields are at multi-decade highs, with U.S. 10-year yields moving toward 4.5% and 30-year yields above 5%, levels not seen since before the financial crisis. Similar moves in Germany, the UK, and Japan reflect a broad fixed income repricing driven less by new central bank actions than by persistent inflation, large fiscal deficits, and energy-related shocks. Expectations for central bank policy have rotated sharply. Markets that started the year anticipating a series of Federal Reserve cuts are now pricing a meaningful probability of an additional hike, with short-dated yields trading above the policy rate and futures assigning rising odds of tightening over coming meetings. Core PCE inflation hovering near 3%. Recent consumer price data annualizing closer to 4 or 5, and nominal GDP growth around 10% make it hard for policymakers to signal imminent easing without risking their inflation-fighting credibility. The bond sell-off is feeding directly into risk assets. Small-cap U.S. equities are down about 20% from late March. Rate-sensitive sectors, such as real estate and parts of housing, face rising financing costs, and even high-flying semiconductor names are starting to wobble as discount rates reset. At the same time, the curve has steepened. Long-end yields around 5% are becoming a psychological reference point for many allocators, and concerns are growing that, without clearer guidance from the Fed or changes in Treasury issuance, term premiums could rise further. There are, however, important offsets and open questions. Private sector balance sheets are generally less leveraged and longer dated than in past cycles. AI-driven investment is keeping growth firmer than many expected, and some metrics, such as the spread between 10-year yields and the Fed funds rate, historically point to better forward bond returns than during the zero-rate era. Yet markets remain unsure about the Fed's reaction function under new leadership, and there is a growing risk that either doing too little or tightening too much could destabilize both bonds and equities, especially with oil still elevated. From here, the key signposts are upcoming inflation prints, any shift in Fed language on its easing bias and balance sheet plans, earnings from major retailers and AI bellwethers, and crucially, how the Hormuz story evolves, given its direct link into both inflation and term premiums. The picture today is one of three powerful forces colliding. A hardening Gulf energy shock is tightening supply, lifting inflation risk, and pressuring growth-sensitive sectors, even as AI remains the key earnings and equity leadership story and global bond markets reprice toward higher-for-longer rates. How these dynamics resolve will depend on the Strait of Hormuz, the durability of AI earnings beats, and whether inflation data gives central banks cover to pause or push on. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.